12.3 million Australians are living in economic Armageddon. Martin North, John Adams, and Interested People. John, we're back. Nice to see you again. Happy New Year.
Happy New Year, Martin. We are back for our season in 2026. A couple of hiccups last year, and that's why we've been off the air for a number of a couple of months. But just to recap, the good news is that despite legal threats to the contrary, nothing has happened in terms of our last series of shows about the ABC pedophile tape. So all those threats were bluffs, and so we are sort of back on the channel, and hopefully we'll have a good relationship with YouTube this year, and so we'll obviously continue. So Martin, we will come back to the issue of corruption because there's plenty to go on with, and obviously since the last episode, obviously the events of Bondi has taken significant precedence in terms of the political sort of situation in Canberra. But I thought we started this program in 2019 looking at the economy and the household debt bubble, and I thought we should come back to that. And unfortunately, we have some very bad news to report to our audience. Starting in 2018, before I met you, Martin, I wrote a 4-part series for news.com, and I was warning Australians that we were headed towards economic Armageddon. And Martin, if you can put slide 1 up, we basically have a summary of the 4 articles that I wrote for news.com in 2018, and it was based on the statistical fact that at that point Australia had the biggest debt bubble in Australian history. At the same time, we had the biggest debt bubble in the history of the world, and that debt bubble has continued to grow. And during that series of articles, I suggested that we were going to head to one of 6 scenarios, which was going to be disastrous. And if we, Martin, we go slide 2. So the model that I came up with in 2018 had 6 scenarios, and the scenario that that we're experiencing now is scenario 5, which is stagflation. And in 2019, I was sort of on the fence as to whether it would be inflation or deflation. But then when COVID hit and central banks around the world announced QE to infinity in March 2020, and then the Australian government under Morrison Frydenberg launched the biggest stimulus package in Australian history, I was firmly in the inflation camp. And we were doing shows in 2020 about the oncoming stagflation. And here we are in 2026, and not only is stagflation well entrenched in the economy, we have up to 12 million Australians living in the worst cost of living crisis in Australian history. And a lot of people didn't really understand what economic Armageddon would look like. But I think while at the time certain people suggested that I was involved in sensationalism and hyperbole, I think for half the population at least, I think the crisis that they're living through at the moment is not what they signed up for in terms of over the last few years. And I think, Martin, if I had described the conditions of the economy today back in 2018 when I wrote those articles for news.com, I think people would agree that the current set of circumstances would be a form of economic Armageddon. Lots of people are struggling, and we're going to go through some of that detail tonight. But also, Martin, I think we're going to explain what has been happening in the economy for the last 2 years and why is the crisis getting worse under the Albanese government.
Well, it's a very important conversation. Of course, I've been tracking this over the last few years through my surveys, and we'll come on to that shortly, because we've seen a building set of issues, real incomes going nowhere, cost of living pressures, the big debt burden, as you say, both from government spending and also from the private sector. So all of those things are in play at the moment. And unfortunately, we look as though we're going to continue to spiral down further ahead, because there is no change of trajectory that I can see, which means that more people, not less people, are going to have difficulty. And the stories really are coming home to roost now, John, aren't they? There are real examples of real households and small businesses and other people struggling. And I think sometimes the overall sort of top line storyline, big numbers, goes past the fact that real people are being impacted by what's happening and what's happened.
Yes, Martin, I just want to share a couple of stories that have sort of come across my desk in the last probably 6 to 8 weeks. About a month and a half ago, I caught up with a mortgage broker who's from Sydney, and I was just asking him how his mortgage business was going and what was the sort of average clientele. And it was quite shocking. He said to me that his average client in the sort of southern Sydney area, we're talking Sutherland Shire, and and that sort of Cronulla area. He basically was saying that the average client of his was late 20s, a couple with a deposit of between two to $300,000. Um, I would suspect that a significant portion of that money would come from the bank of mum and dad, which is something you've spoken about quite a bit on your Walk the World channel. And in order to get a entry level home, so we're not talking a flash home or a upmarket home, just an entry level home for a Sydney couple in their late 20s. They were borrowing north of $1 million, even though they had a deposit of 200 to $300,000. So entry level homes in Sydney are in the order of 1.3, $1.4 million in the current market. And so when this person said that the regular clients were coming to him borrowing north of $1 million, and this was their first home, I just was sort of obviously inquiring, was this interest only loans? It was this principal and interest, given that particularly pre banking royal commission, interest only loans was a very big thing around 2014, 2015. But he said no, these were mainly principal and interest loans. And then I just asked him, well, what is the average repayment that these new loans, these new couples are actually having to come up with? And he was saying that the minimum repayment for if you're in your late 20s, you probably could get a 35 to 40-year loan. So we're not talking the standard 30-year loan, but the average monthly repayment, the minimum repayment, is between $6,000 to $7,000 a month. And I was just sort of shocked with that number. And he just said that all of his clients who are signing up to get into the property market in the current environment are putting themselves under significant pressure. And while they, obviously get to live in the home that they want, because they want to they want to actually have a roof over their head and they don't want to rent. The amount of financial pressure and the amount that they're, I guess, stressing and trying to run themselves through work is just extraordinary. And Martin, I think we've discussed this in the past, but I have no debt. I've paid off my mortgage. I'm happy to say that during the pandemic, I had no debt at that point, and neither did you. In 2022, I did actually upsize the house that I was living in because I had my third child, and I was fortunate enough that within 2 years I was able to pay off my new mortgage, which was about $500,000. And so since 12 months ago, I've been debt free in terms of mortgage debt. And so while Australians have been running into debt, I ran in the opposite direction. And I couldn't imagine the stress that I'd be under if I'd have to come up with, $6,000 to $7,000 a month in new repayment. So that was one of the stories that really caught my attention. And then there was another story that I had a tradie, a painter here was over my house doing some small painting jobs inside and fixing some damage that was that happened in my house. And we just got he's a viewer of the show, and uh, uh, he's very clued in with the economic trends, etc. And I just asked him about what he's hearing among his friends and family, and he said that he himself, as a tradie painter, was in debt to the tune of $750,000, and that all the people that he knows around the Illawarra, friends and family, in-laws, etc., he said everyone is in debt to the tune of anywhere between 750,000 up to 1.1 million. And obviously, Wollongong is a regional sort of area, a regional town in terms of New South Wales and Australia. So no doubt, if you were talking to people in the capital city, the average debt that people were holding would be higher. But he just said that it's unheard of that in his circles. And I've had the real estate agent that I bought my house through. He just said that for, I guess, my circumstances here in the Illawarra, it is unprecedented in the current environment that you would have a household that would have no mortgage debt. And so the fact that I have no mortgage debt and I don't have that stress compared to everyone else is quite extraordinary. But when I hear these stories of minimum repayments of $6,000 to $7,000 a month, and everyone in the Illawarra is sitting on anywhere between $750 to $1.1 million of mortgage debt, and this is just the accepted standard. Something I think is fundamentally wrong in the economy.
John, I absolutely agree with you. And I have these one-to-one conversations. So this is with households who are making some sort of financial decision, often around property. Now, I don't give financial advice, but the conversation I'm having often is based around three things. The first is that there are people who are aspiring first-time buyers trying to think whether they can possibly jump into the property market and leverage up 8 times, 9 times income to get a mortgage to be able to buy a property, even if it's a property in a relatively uninspiring place or maybe in poor condition. The second is those who've actually held property for some time and are really just bursting at the seams, but they don't know whether they should try to move and upscale or not, and what are the financial implications if they do. And the third one is those who are old and moving towards retirement, still with massive debts around their neck, and really beginning to sort of question whether they'll be able to have a retirement of any sort or shape or size because of the fact they've still got a mortgage, their incomes are going to degrade. Oh, and by the way, there's also quite a few people who are in the rental sector. They're actually the most stressed of all, actually. And a lot of people in the rental sector are trying to say, well, can I possibly save a bit by going into the owner occupation sector of the marketplace? But when you do the maths, it's actually very hard to see how they can do it. And look, everything's getting worse. And the expectation that people had was that there would be considerable rate cuts coming through, and there would be real income growth. And those two things would get people out of jail. And in the early 2000s, that's what happened. But this time, the expectation now is that interest rates are probably not going to come down much further, if at all. Real incomes are still getting squeezed. And meanwhile, both the policy settings from the government and also individual aspirations from households are driving in a different direction. So it's a real mess. And I'm very disappointed, actually, by the quality of the reporting in the mainstream media, John, about these sorts of issues, because, you know, they don't really get to the heart of it. They're all spooking the property boom and how much people have made on the capital appreciation. But the truth is that there's a really, really important story here. And as you say, the degree of pain and strain across the Australian economy is probably never been higher.
Yes, Martin, I'd like to ask you a couple of questions. The first one is that now with in terms of older Australians, I'm assuming it's correct because I think I've read this in some reporting that with older Australians heading towards retirement with these big mortgages still over their heads, um, some of them are hoping for their superannuation to basically be there to not fund their retirement but to settle their existing debts. But in many cases, the superannuation balance is not enough to pay off the mortgage. Is that have you seen evidence of that?
Yes, I see that in my surveys and, in fact, in one-to-one conversations too. When you do the math, because of the fact that people have tended to draw down more equity from their property, maybe for improvements, maybe holidays abroad, or maybe even providing funds to the bank of mum and dad for their offspring, they're finding that the superannuation pools that they have are not going to be sufficient just to clear the mortgage. Also means, of course, that those people are going to go on to the government pension because they're going to have very little in the way of other income sources. And what it means is that their standard of living is going to drop dramatically unless they continue to work. So the other factor is that people who are planning to retire are kicking out retirement age, not just by a few months, but actually by quite a few years. So absolutely, I see that in my data.
Yes. Now, the second question I have is that you said that people took on these debts in recent times on the expectation of rate cuts and income growth. So can I ask from your consultations and from your surveys, where did these expectations come from?
Well, they were getting the expectation of rate cuts from the reporting in the mainstream media, and I suspect actually sort of circulating around the RBA conversations and the fact that every time the RBA comes out and says something, a lot of people saying, see, we're going to see more rate cuts. Plus, of course, the agents out in the field, the real estate agents, are always saying, rates are coming down, buy. When it comes to the other question of real income growth, there they are listening to Jim Chalmers. I call him Spin Jim these days because he's always talking about, you've never had it so good. The income growth is stronger now than it's been. But actually, in real terms, a lot of people aren't feeling it. So I think there's a dissonance between what people are actually feeling themselves and what the mainstream media and the politicians are saying about their situation. And that gap is getting wider.
So yes, so basically, we're living in a dystopian society where the establishment media, RBA, and politicians are basically lying to the public, and the public knows that what they're being told is not true. Because you said about what people feel, but I think this is beyond what people feel. I think the actual hard numbers of household budgets is not stacking up to the narrative of the government.
Well, I would say that the problem is we actually have what I call a K shape going on at the moment. So there are some households who are sitting on quite large asset portfolios. Maybe it's property, maybe it's stocks and shares and all of those things. Maybe some of them will be older. They don't have a mortgage and they're doing reasonably well and feeling pretty good. And there are also some more affluent people, maybe the people working in the banking sector and things like that. I would say that they're the mega haves. So they're doing really, really well and having a real field day, right? And they are the ones that a lot of politicians seem to be aligned to. But this other larger cohort, the people who are under the gun when it comes to trying to balance income and expenditure, money in, money out, as I say, they're the ones that are actually really feeling it at the moment. And I don't think that the politicians generally actually get just how bad it is. And, whilst people talk about, there's pain, nobody really wants to admit just how deep the pain goes. And I might put up my stress slide here, John, because it's quite significant. When you look at this is the data from my surveys, and you can see that the blue line is rental stress. So that's about 75% of people in the rental sector are struggling with money in, money out. In other words, they don't have enough money coming in to cover the costs of the rent plus everything else. In mortgage stress terms, roughly half of households with an owner-occupied mortgage have cash flow pressures too. And if you look at those trends back to the year 2000, you can see that, well, it's hardly ever been higher. Rental stress is just down a tad, but it's still very high. The other interesting observation here is that the RBA keeps trumpeting the debt-to-income ratio in their statistics, the last data for September, at 176, but they keep correcting down that number from what it was previously. And yet, of course, it doesn't tell you the full story because that includes all households, whether they're borrowing or not. So actually, to get a true picture, you need to multiply by at least 3 times. So the average debt-to-income ratio for households with a mortgage would be closer to 6 times rather than the 176 or 1.76 times that they're having here. So that's a really big deal. And look, this trend is horrible, and it's not just in Sydney. This is a national average.
Indeed, indeed. So obviously, when you look at more expensive areas like Sydney, I suspect that stress would be more elevated than other parts of the country.
Not necessarily so, actually. There are areas in Western Sydney in particular where it's very, very difficult. But actually, places like Adelaide and now Perth and Hobart and Melbourne are all recording high levels, plus some regional areas. For example, Toowoomba, up in Queensland, is another stress area as well. So it's a patchwork across the country. Plus, there are also some households, more affluent households, who are also feeling it. So it isn't just lower income households. It isn't just younger households, even though a lot of first-time buyers are being caught by this and a lot of first-generation migrants coming to the country being caught by this. A lot of households in other cohorts are also now feeling it too. So it's a patchwork.
Yes. Now, Martin, one thing I wanted to say was that when in 2018 I was writing about economic Armageddon, it wasn't just going to be a economic crisis. It was also going to be a social crisis because typically, when you look at economic history, when there are significant, tumultuous economic events, it does impact people's social lives, in terms of their quality of life decisions, mental health, etc. And so, again, when I talk about economic Armageddon, and because people have said in the past, well, where is the Armageddon? Well, or just to show that the Armageddon's here is not just in terms of your stress numbers, but I mean, look at some of the other things that we've been able to uncover is obviously one thing that we've discussed in our pre-show was about household formation, and I think the data suggests that people are living with parents for longer. Household formation is being delayed by 5 years. Women are having children later. Children, like parents, Australians are having much fewer children, and a lot of this is being driven by the economic crisis because a lot of parents don't feel that they can actually afford to have the number of children that they want. And Martin, if we put up slide 4, this is an article from the ABC, and this is from October last year. Australia's baby recession deepens, new ABS data says, and basically saying that the in 2024, fertility was at the lowest rate ever at 1.48 babies, down from 2023, and the average age of mothers, first-time mothers, is about 32, and the average age of a father is 33. And so obviously, you know, there's a very big question in terms of uh, the size of the Australian population, the demographic profile, immigration, where those immigrants come from, and so this demographic question is a significant one, and obviously policymakers need to get more Australians to have more children if we're going to have a vibrant economy that's going to be able to generate the tax revenue to fund the particularly the age pension and the other welfare entitlements. So we need a certain size of economy to finance all the government obligations. But obviously, with so few women having so few babies compared to previous generations, we are going off a demographic cliff. And I mean, there are other countries around the world experiencing this. I mean, Japan, South Korea, and a bunch of other countries. And so obviously, the decision to have children, and when you have the children, I mean, that's obviously playing a significant. This crisis is playing a significant role in terms of household formation.
Oh, it is absolutely. And of course, that links us onto the question of migration, right? Because the government has been turning up the migration levels quite strongly, particularly in the last 2 or 3 years. Well more than 1 million households have come into the country in that time. So that's an additional demand for property, of course. Now, from a Treasury perspective, more people means more tax take and means more economic activity. But of course, the downside is it means more demand for property. And quite often, some of those people come in with reasonable amounts of money in their pockets and are able to continue to bid prices higher. Although, interestingly, some of those first generation people who come into the country, I see them in my mortgage stress data and rental stress data as being some of the most stressed, particularly in rental stress. So they tend to come in and discover that actually housing is really expensive in Australia and they're having to spend a lot of their income on finding somewhere to live. So it is definitely a problem. Plus, of course, it creates a huge amount of pressure on transport and hospitals and schools, all those other things too. So in a way, by turning the dial towards migration and away from homegrown children, that has brought forward pressure on pretty much all the resources in the country. Of course, if you have a child, it's going to take some time for that to work into the system. But of course, a big migration bulge can actually create significant demand much more quickly. And that is another technical problem, which I think people haven't fully understood. And of course, anybody who then hears about questioning the volume of migrants immediately then links back that into saying, oh, you're being racist. No, I'm not being racist. I'm just being an economist trying to get to grips with why it is that ordinary people in Australia are really struggling. And to me, migration is another part of the story.
Yes. One of the other big social phenomena that we're seeing at the moment, Martin, and this is something that you sort of brought to my attention, which I was very shocked with, and I've actually spoken to a number of people in the last sort of week or so mentioning your statistic, which is that of those that actually own a home that have that have some form of owner occupier ownership, um, only 28% of homeowners have no mortgage, whereas 72% of homeowners have some sort of mortgage debt. Now, I'm in the category of the 28% of people that own a home that have no mortgage debt. And and yet, look, to be honest, look, I thought that that number would be a lot higher, but I think the data shows that maybe in the last decade that number was up to about 35%. And over the last decade, as we've seen, gone through COVID and all the money printing that we've experienced and all the inflation, that home ownership with no debt is down to only 28%, which is a very low number in terms of what I was expecting. The other thing, Martin, is that I think the data also shows that people entering the property market, people are entering in much later. So we're starting to see people in their late 30s, early 40s getting into the real estate market for the first time. Whereas I think looking at some of the data, there was a significant portion of Australians 25 years ago who were able to purchase their first property in their late teens, early 20s. And obviously back then, I mean, I was just finishing university then. A lot of people who were entering the property market were able to basically buy an apartment, maybe with some assistance from their parents, maybe through savings, etc. But um, you know, putting together $20,000-$30,000 for a deposit for an apartment in say Wollongong in say 1999, 2000, that was feasible. But now we it's only less than 1% of people in their late teens, early 20s who can actually get into the property market. So the ability to secure property, the age that has blown out, the ability to move out of home, the ability to get married, the ability to have children. This is all being impacted by this current crisis, and the impacts are not just immediate, Martin. These are generational impacts, which will be felt in the next 20 or 30 years. So these are so this crisis is going to have some very long-term consequences if we're not able to turn the ship around.
Yes, and I would also add, John, a couple of other observations. The first is that the duration of mortgages has extended dramatically from where it was previously. So people are actually more indebted than ever for longer. And also, the banks now assume two full-time incomes when they make an initial assessment of a mortgage rather than one and a bit of income. So people are actually borrowing more for longer, which is great for the banks, of course, because they can create ever more profits for their shareholders and blow up the balance sheet. And the other interesting observation, you mentioned social trends. I've been watching the crime rates, violence, and also those relating to robbery and other things. And there's a strong correlation between high levels of financial stress, whether it's mortgage stress or rental stress, and rising crime rates. So not only are there specific issues for the household dealing with cash flow pressures, but the social consequences for that particular part of the country and that particular area are quite dramatic and continuing. And that's really my concern, John, that what we're doing here is we're laying a seeds, not just for now, but for the next 20 or 30 years. And the seeds for more disruption from a societal perspective, more pressure on households. And that's going to play out, I think, very negatively. And, years ago, I always used to think, John, that Australia was a great place to live because it was always, she'll be right and everything's fine, the sun's shining. But for a lot of people these days, well, it's just so painful.
Yes, and and one could argue that maybe that's one of the reasons why you escaped back to England. You were able to foresee how bad it was going to get, and you have escaped to a much a much better part of the world. But Martin, if we can go on to the next slide. So when you talk about the generational impact, I mean, this next slide I thought was quite interesting. So this is the 2025 Australian Youth Barometer, which looked at Australians between 18 to 24 years old, and they did a survey. And some of the things that popped out in the survey, which were very telling. 85% of this cohort experienced financial security. 79% think they're going to be financially worse off than their parents. Only 50% want children. Only 46% think they can only have they can achieve financial security in the future. Um, Only 42% think they can get a house, and 26% rate their mental health as poor or very poor. Martin, what I know from history, whether and I'm thinking specifically about the French Revolution, when you have young people who don't have confidence in their future, and who feel that there is, economic desperation, it leads to political extremism. And so, obviously, in the case of the Bondi terror attack, and the current debate about hate speech laws, and Nazis, and all this sort of stuff. When and again, look, not to say this is all driven by economics, but what we know is that when young people feel less confident in their future, and they don't trust their political leadership to deliver a stable and vibrant society, they go elsewhere for solutions. And some of those solutions result in political extremism. So again, so when we talk about the long-term impact, when you have 25% of young Australians saying that their mental health is poor or very poor, and they don't have, and they're, almost 85% of experiencing financial insecurity in the last 12 months, it's a very dire situation for the future of the country. And if Canberra doesn't actually do what is necessary to fix this crisis, where the electorate is likely to vote into the future could be in a very radically different direction to what we have been used to for the last 2 decades.
Yeah, and I will add, John, that we've seen significant data now showing that younger people have significantly higher levels of mental health problems of all different sizes and shapes than previously. And some have sheeted that to the impacts of the shutdowns around COVID and things like that. More young people are finding it difficult to find any work. In the UK, there's some astonishing numbers about how many people are not in education and not in work. They're just sitting around on benefits and just not interested in engaging with society and engaging with the workforce. And that's a very significant factor in Australia too, which means, of course, there's no chance of getting household formation happening because people aren't actually in the working environment. And at the other end of the spectrum, some of the older people who were thinking that they will be able to have a comfortable retirement and look forward to the best years of their life, they can't get over the hurdle to moving into retirement because of the fact that the financial pressures on them are also so great as well. So we do seem to have created societal imbalances and consequences. And, I suppose we could discuss who's responsible. Is it the individuals for the decisions that they've taken or not taken, or is it actually government, or what is it? But the net effect of all this is that we've got a society that's looking sicker and sicker overall, as well as from a health perspective. And the point I want to make, John, is I can't see that we're spiraling out to somewhere different. Rather, we're spiraling down to the same old, same old. This is going to get worse, not better.
Yes, yes. Look, totally, totally. I mean, the thing is that and the other thing I would say, Martin, is about the current sort of pressure that people are under. And when we talk about young people, so this survey just talked about 18 to 24-year-olds, but also school children are also experiencing significant pain, even though they're not actually, directly facing economic pressure because they're not in the workforce. But Martin, if we go to the next slide, so this is an article from The Guardian only in the last fortnight that says that people are struggling to afford the basic necessities for children to go to school. So this is the quote. It was the third consecutive year more than 80% of families surveyed said they couldn't afford school items, echoing Curtin University's child poverty report released late last year, which found that an additional 102,000 children fell into poverty during and after the COVID period between 2020 and 2023. So, Martin, when you say look, and I'm not sure, I'm so interested to see if your data corresponds with this report that 80% of families are struggling to afford school items, and obviously January is when there is significant expenditure on school items, whether it's your uniforms or shoes or, the other sort of, things, books and laptops, etc. And January tends to be a difficult month generally because obviously people spend big during Christmas, and January is when they try to sort of try to pay down some of the credit card debt. But yeah, I mean, 80% of households struggling to afford school items. That's a very serious number.
Yeah, well, it's consistent with what I'm seeing in my surveys. And interestingly, some of those households are cutting back on medical expenditure, for example, not going to the dentist and not necessarily spending what they should be spending on medical services. And interestingly, when you look at what they're spending on food and the type of stuff that they're buying, they're tending to buy the processed food, the cheaper food, rather than the really good quality food. So there's a dietary question here, as well as an education question. And wherever you look, people are having to make horrible compromises with regards to trying to squeeze their life into a smaller budget. Another interesting observation is they still tend to spend quite a lot on subscriptions to streaming services and mobile phone plans and those sorts of things. So it's fascinating to me how households are prioritizing their budgets and where they're spending big versus where they're spending less big. So, for example, people are cutting back on health insurance and they're also cutting back on insuring their property. So quite a few people are underinsured from a property perspective relative to perhaps what they should be. And so what you're seeing is this compromising thing going all the time. People are having to make trade-offs between what do I spend here, what do I spend there, I can't afford to do this, can't afford to do that. And the net of all of this is it doesn't make Australia necessarily for many people a very pleasant place to live now. But again, what's the legacy going to be? And that's what I get worried about. We're laying the foundations here for the next generation. And well, they don't look very flash to me.
Indeed. Now, the key point of this show, Martin, is that, and this is what we're going to get into the next set of slides, is so why is it happening? Why is 2025, 2026 the worst on record? And why does this crisis continue to unfold in a very, in terms of a very negative fashion? Because once you start to look at the debt data, we have a very interesting story to tell, and it'll be interesting to see, how we're going to have a slight disagreement at the end of our next part of the conversation. But Mana, if we go to the next slide, so the key point I want to say to the audience is that during COVID, we basically saw a significant surge in debt as we had the unprecedented stimulus, which we've covered in previous shows in terms of JobKeeper, JobSeeker, or the financial payments, ultra low interest rates, almost zero, yield curve control, quantitative easing. They did anything and everything to encourage people to borrow, to stop the banks from going under. And that's where we saw, if you look at this graph here, we saw a massive surge and so this is annualized housing debt growth. So looking particularly around mortgages for owner occupiers and investors. So we saw a massive surge from 2020 through to 2022. And then as interest rates started to go up in 2022, growth moderated, came back down to 4.1% by November 2023. But here's the key thing, Martin. Since mid to late 2023, the growth of debt. So it's not just that people are getting into more debt, but there's an acceleration of debt accumulation by households. And again, so when we look at, so these are national numbers. So part of this would be migration. So there are more people in Australia, and more people mean that more people are taking up more debt. But I think, as we've discussed in our pre-show, that more Australians are taking on larger quantities of debt compared to, say, 2021, 2022, or even before COVID-19. So the reason why the economic crisis is getting worse is because more and more people are taking more and more debt, and a lot of that additional debt is being concentrated in the property market, and it's kind of like a Ponzi scheme. It just, I mean, you just got people continuing to bid up property to ever higher and higher levels, and while people can borrow more and more debt, the bubble just keeps on growing. And this debt acceleration story is a very fascinating story. And I don't think a lot of economists in the marketplace have spoken a lot about why is Australians accumulating higher debt. But this is the key point. at a much faster rate. And that is the key story of why 2025, 2026 is horrifying for a lot of households. But Martin, before we get into the other graphs, did you want to maybe talk about this second surge of debt that we've seen from 2023 and reasons for why the debt has accelerated in terms of the growth?
Sure, absolutely. And look, 6.6%, that's much, much higher than the inflation rate. So just bear that in mind. Real wages are growing nowhere near as fast as 6.6%. So there's an interesting comparison there. So what's going on? Well, the first is there's been a very significant uptick in investment lending. So more property investors piling back into the marketplace. And so if you look at the split out between investor and unoccupied, in fact, investor is stronger than unoccupied, although both are moving up firmly. We're seeing a lot of people having to borrow big for first-time buyers to be able to get in. And of course, the recent government changes to allow a 5% deposit means that people can actually potentially get a smaller deposit and still buy, but they have to borrow the full amount, of course, that they're needing to borrow still. And that means that the dollar value is higher. And we're also seeing the continued drawdown of existing equity in existing properties. That's still a phenomenon. People still using their properties like the old ATM, and that could be for property renovations, or it could be for holidays, or it could be to provide some funding for kids through the bank of mum and dad. All of those things are there. And there's a very significant proportion of people. In my surveys, around 40% of people have increased the amount of debt, not reduced it, increased the amount of debt on their existing mortgage for those various reasons. And then the other factor in all of this is that we've got this quite interesting phenomenon where people are still aspiring to get larger properties or having to pay more because the average price of a property continues to rise. And of course, if you want to buy it, you don't have to get a bigger mortgage. So they're chasing higher property prices, or maybe it's the mortgage expanding because the banks are prepared to lend more, up to 8 times income. So at the moment means that they can borrow more, which means they can push prices up, which means that they can borrow more. So it's a bit of a circular argument. Oh, and by the way, the APRA intervention, which is quite significant, they're going to impose from February a speed limit on investment lending, but that's like imposing a speed limit of 200 kilometers per hour on the road. The banks aren't at the moment predominantly speeding anywhere close to that limit. So there's still plenty of capacity for more lending growth. And even with the expectation that rates probably won't get cut further, that so far has not had a dampening effect on the growth rates. Banks love it, of course. Basically, they are big bailing societies. Most of their lending is for mortgages compared with small business. And the banks are loving it. But at the end of the day, debt has to be repaid, and that's a problem.
Indeed, indeed. Martin, the key point I want to sort of say to the audience, if you go to the next slide, is it's not just a function of mortgage debt, but the next slide is even more fascinating, which is which is coming from the RBA, which is non-mortgage debt. So if you look at the slide, I mean, before COVID-19, and if we look at 2019, personal debt, so non-mortgage debt was actually shrinking. And I remember, Martin, in 2019, we did maybe 1 or 2 programs where we talked about how Australians were refinancing their mortgage. And in the refinancing process, they were consolidating existing debt. So if they had a car loan, a credit card, other types of loans, they were basically rolling those loans into the mortgage. And that was one of the factors for why non-mortgage debt was actually shrinking. And obviously during COVID, people were tightening their belts. They weren't able to spend. They weren't able to go out. So, with all the income support, people were again piling money into trying to reduce those debts. And that's why, if you look at 2020, 2021, non-mortgage debt was shrinking to the scale of 12 to 14% on an annualized basis. But again, since May 2023, non-mortgage debt has started to grow. So we've had years of non-mortgage debt shrinking even before the pandemic, and yet since 2023, non-mortgage debt is actually starting to grow. And so yes, it is again a part of a function of migration, because you do have more people in Australia, and new immigrants are able to obtain new forms of credit, whether they're credit cards, etc. But Martin, one of the things that we talked about in the pre-show was credit card balances are up, and we'll talk about that in the next slide. But car finance, personal loans, in terms of non-traditional forms of credit, zip money, and obviously other forms of non-traditional forms of credit as well. They're all playing a part in terms of this non-mortgage growth story. And one of the things that I know is happening in the Aurora is that a lot of people in terms of energy are moving towards solar solutions, whether they're solar panels, solar batteries, solar hot water systems, for example. And there's a lot of demand, in among middle income families to move away from fossil fuels. And a lot of these systems cost anywhere between $10,000 to $20,000, and they're all being financed using credit. And so a number of the Wollongong companies are basically saying to couples, you can pay all the whole cost of the system up front, or you can take a 7-year non-mortgage debt solution, and your payments will be small. Once you try to do the calculations against how much you'll save in traditional utility bills, it sort of comes out even. And a lot of people are engaging in non-mortgage debt to basically go solar in terms of their household energy sort of systems and costs. And so yes, so very interesting phenomena in this non-mortgage story. But again, it was shrinking for a long time, and now it's growing, and that's obviously played a role in the exacerbation of the current crisis.
Yeah, and I will just say, John, that in my surveys, what I find is that people who have got financial pressures will continue to try and swim, and they will then reach for credit, and then for more credit, and then for more credit, and then maybe they'll try and refinance and get some of the money out of their property if they've got property, and then can pay down some of the other debt and then go again. I'm also seeing another very worrying phenomenon where people are actually using the buy now, pay later facility on their cards to buy things like food, which is, an everyday expense, but they're wanting to spread the costs. And what I'm seeing is that you have an accretion of debt, particularly consumer debt of various sorts and sizes, on those households who also have massive mortgage debt as well. And so they get into this downward spiral where the only way that they can continue to survive is to continue to expand their debt process. And that means, of course, that the interest rates that they have to pay debt on is a lot higher than for, say, the mortgage. And it also means that they're having to spend more and more of their income on trying to service the existing debt whilst trying to continue to swim. This is a horrible process. And when I've spoken to some of the debt counselors I've done recently, they've made an observation that over the Christmas period, they had one of their busiest seasons ever, because people actually over Christmas had time to think about what they were doing. And it's quite hard when people have got so many different types of debt all going on at the same time to be able to find a way out. Now, the credit card interest rate debts are very, very high still, of course, relative to mortgages. And quite often what we find is that people actually switch from credit card to try and actually balance it all out. This is a real, real concern. And there's no simple, easy way out other than turn your spending down relative to your income and pay off the more expensive debts first. But that's actually quite hard to do. And interestingly, if you look at the credit card data, as we'll see in a second, credit card data of outstanding balances is also rising as well now.
Indeed. So Martin, if you go to the next slide, we can have a look at in terms of total credit card debt, and so we can see that from 2018 through to 2021, credit card debt actually shrank quite a bit, and obviously that was a function of debt consolidation, moving to non-credit card debt facilities like pay now, buy later, and that facility is not considered to be a debt product. And I think that's something that we've discussed in previous shows. But obviously, since 2021, total credit card debt has continued to go back up, but also credit card debt that incurs interest is also trending up as well. So yes, so more credit card use, and obviously buy now, pay later has been a big shift in terms of consumer sentiment. But even though that has come into the economy, and that's not included in this credit card debt, and a lot of people have shifted away from credit cards, it's still the fact that more and more credit card debt is piling on. And again, Martin, I think you're correct to say that a lot of people who maximize credit cards and then obviously maximize other forms of credit, they don't have any real plan of how they're going to get out of this, out of the situation that they're in. And again, look, when you're under pressure and you're desperate for cash to just pay your immediate bills, it can become very challenging if you don't actually have those sources of income.
Yeah, and I will say, John, that financial pressures lead to relationship breakdown and all sorts of other things too. So when you actually look at some of the data on, why relationships failed, it's often the financial pressures got too much, and it is often the case that broader consequences follow from this debt binge that people have been on. And look, I don't blame it on people altogether, because of course from very young now they're educated about, well, you can get debt when you go to university and your credit card's fine, and get a mortgage, take two, we'll lend you 2 times full income on a big multiple, and everyone is loving it. But the point is, there are consequences from those decisions that people have taken, and then when they get into difficulty, the only way out is then to borrow even more. So the bigger the pressures get, the more the use of debt continues. And then, of course, eventually something gives. Now, that journey of how long does it take before something really gives, that can be years. So people are on this grind when they're effectively spending as much as they can, trying to keep their head above water, and the debt continues to build. And then they ultimately have to take a more worrying decision because, of course, they leave it quite late. And again, quite often in my surveys, I find that roughly half the households in my surveys don't really have a strong sense of their finances, where the money's coming in, where it's going out. So if they don't have a cash flow, if they don't really understand it, it's not surprising that they don't manage it very well. But again, I think it's a societal issue. And I do think it's also the fact that the banks, of course, are always happy to lend, aren't they? At some price.
Yes, yes, and in terms of that point, Martin, the banks that have to lend, it's not just for households. I mean, in terms of debt acceleration, debt accumulation for businesses is also growing very aggressively. So, Martin, if we go to the next slide, and again, this is I mean, me being an economist looking at this for a couple of decades, I've been very fascinated with this particular graph, because we're seeing that annualized in terms of business credit growth, again, pre-COVID and during COVID, growth was less than 6%. And obviously, once we get to 2021, business credit was actually negative when we were in the COVID recession. But since 2022, um, in terms of the amount of debt that businesses are taking up, it's actually grown aggressively, and it has actually stayed above 6% per annum. So again, so ever since 2022, businesses are taking on ever more bigger debts, and the growth of the debt accumulation among businesses is faster than obviously before, during COVID, but also before COVID. And 2019 was a period where the economy was slowing down, but yeah, the fact that it remains above 6% is quite interesting. And Martin, I know that for a lot of small businesses, I mean that they obviously they struggled through the COVID period, and they needed to take on different forms of debt just to make cash flow and sort of keep their doors open. And sometimes people take on business credit facilities. Sometimes they mortgage their house to finance the business. I'm not sure whether this data reflects small businesses that mortgage the house to finance the business versus businesses taking other forms of debt products. But what do you see in this graph, in this phenomena?
Well, certainly strong growth, but you need to tease it out a little bit, because there are some sectors, for example, mining investment has been tailing away over the last few years. And in fact, the amount of investment in new mining is quite a lot down. There is significant investment at the big end of town, among some corporations. And there's a lot of investment at AI related stuff. So, for example, data center development and those sorts of things because of the AI boom. So, in a way, that's masking something else which I'm seeing, which is that some of the small businesses still cannot get credit to actually keep their businesses afloat. And the amount of lending from the banks towards the small end of town for small businesses is still way down from where it was. So it's not a uniform story, but the net effect of all this, and if you sort of pile on the business lending, and you pile on the consumer lending, and you pile on the mortgage lending, and then you pile on, of course, the government borrowing as well, because the government's been spending big, put all that together, and guess what happens to the broad money supply? Well, you can see here on the next chart, it's quite fascinating. It's now rising at 7.1%. That is inflationary. And one of the things to understand, John, as we often say, money supply and inflation is, well, rather significantly linked, isn't it?
Of course, of course, and with this graph, Martin, obviously, in terms of the growth of money, again, it's continued to grow faster since mid 2023, and we have had this narrative from the government, from the Albanese government, the RBA, etc., that inflation is under control, it is within target, and the evidence is that inflation has continued, or look, money supply has actually grown well above where we were in 2019. So in 2019, when we were within the target, money supply was growing less than 4%, and then obviously since 2023, we're growing faster than 4%, all the way up to 7%. So obviously, what we saw in the last, I think, 2 months, Martin, and I know that you did a show with Tarek Brooker on this, is that once the government removed the energy subsidies, the electricity subsidies, we saw a massive shock upwards in terms of the CPI. So the official inflation data is well above the target, and obviously they were masking that inflation rate by subsidies that was keeping certain prices in the CPI basket down. But obviously, anyone who thinks that that inflation's under control, they shouldn't believe what they listen on TV or read in the newspapers. They should be just looking at the raw data from the RBA, and you can see that money supply growth is continuing to grow faster. And again, that leads to not only more debt, but debt at a faster rate. And that obviously just exacerbates the problems to the point that people are feeling perhaps the pinch more so now than ever.
Yeah, and I'd say there that if you look at the bond rates, they're up. The reason the bond rates are up is because the price of money has gone up because of this issue. The fact is that the government is still issuing a lot of new bonds out there, and the inflation forward expectation based on the markets now is that the cash rate will be above 4% in 2027 at the moment, rather than at 3% or something like that. Inflation is still there and strong. It's all connected with all of this stuff. Now, that takes us, of course, to the consequences of all this, because there are huge, huge consequences. And as we said at the top of the show, a lot of people are in difficulty, a lot of pressure on households. But I suppose we should sort of ask the question, so where do we sheet the blame, John? Is it households just overspending? Is it the government doing funny things? Is it the international money markets? Is it Trump? What is it that's created this nightmare that we're talking about?
Well, I mean, look, so here we're going to have sort of a bit of an interesting debate to finish off the show. So we have this economic Armageddon. I mean, Martin, I think it's fair to say that since 2018, when we started doing our first set of shows on Walk the World, you and I have been super critical of policymakers, and obviously I continue to be extraordinarily critical of both Treasury, the government, APRA, ASIC, RBA. But there is a interesting story as to, okay, so we have had this growth in debt, and it's getting faster. So who is to blame for that? And Martin, if we put up the next graph, because I think this is a bit of an interesting story. generally, Martin, in 2019, and then obviously in the COVID period, I was highly critical of monetary policy because the biggest driver of debt growth is interest rates. And obviously, we had a cash rate of around like about 1% or 0.75% in 2019. It went all the way down to zero plus yield curve control and quantitative easing during the pandemic. But since 2022, Martin, interest rates have gone up dramatically, and interest rates peaked in November 2023 at 4.35%. And over the course of 2024, interest rates stayed at this higher level, and this is the highest official cash rate since 2011. And it's only in 2025 that interest rates were cut three times. And so we're at, I think, about 3.6% at the moment. But if you look at New Zealand, New Zealand's at 2.25%. So Martin, we had a bit of an interesting discussion in our pre-show about this. So there were other central banks that raised interest rates earlier, and they took interest rates higher to where the RBA did. And so the US Federal Reserve got their official interest rates above 5%. New Zealand went above 5%, and obviously others as well. We got up to 4.3%. So I am critical of the RBA that they should have raised interest rates earlier, even though the Philip Lowe said that rates were not going to go up, and interest rates should have went higher than where they ultimately did. But I would say that the official cash rate has been at the highest level in 2023 and 2024, and also 2025, the highest level since 2011. So the second acceleration of debt that we've seen since mid 2023 to now, it's not necessarily a function of interest rates because interest rates have been high, relatively speaking, and remain high. So there are other factors at play. And so some of those factors obviously deal with migration, with more people. More people mean more debt, more demand. More people mean higher rents and obviously more demand for housing and bidding up prices. You have that. You obviously have the stage three tax cuts that the Albanese government brought in. You've had obviously other income support payments, rental payments, energy subsidies, and all of these things have obviously fueled demand. But Martin, um, uh, my view is that these measures around tax and some of these other government payments that they have been sort of at the margin, and they have been sort of in some of these income support payments, they've been one-off payments, and so I think that from 2023 to now, uh, it's not necessarily been public policy that has driven this phenomena as the primary factor. So government policy has definitely has played a role, but particularly because interest rates have been elevated, I think that if we are to sort of shift or to cast some blame at the moment, I think ordinary Australians have to take some responsibility for the decisions that they have made. Now, I think Martin, in the pre-show, we talked about commercial propaganda. People are now accepting of debts. People taking a high debts is a normal phenomena. But Martin, I've been subjected to the same propaganda when people say, use your equity in the property, don't worry about paying off the mortgage. You go on a holiday or buy a new car or do this or do that, and you can just finance it and pay it down the track. I've resisted all of those pressures. Obviously, I have young children, so I haven't had the child come to me and says, "Dad, can you borrow $200,000 so I can get into the housing market?" So I haven't been the bank of mum and dad, but I can say right now, if I did have a child approach me to go into debt to finance their property purchase, I just personally wouldn't do it. And I'd work with my children to find an alternative solution. So Martin, even in the Illawarra, when we've had these high debt levels, I still hear stories of people buying new cars and going on holidays and obviously living like that everything's fine. And for me, I haven't been on a holiday since, in terms of an international holiday, since 2013. So ever since I've had children, I've never left the country. So people can make particular choices that would not place themselves in this situation. And my feeling is that there's been a lot of Australians who for whatever reason, whether it's by necessity or by choice. And Martin, I think one of the things that you said, which was very interesting, is that parents are spending money, significant sums of money on streaming services, but not paying for adequate food for themselves and their children. I think there's a some sort of perverse social phenomena happening that individual Australians have to take responsibility for their own situations. And obviously, once you add up those poor choices to a mass, this is how we get to the crisis that we're happening now. That's my views. Yes, public policies played a role in terms of what we've seen, but this debt acceleration process, it can't be argued that it's interest rates that's driving this, unlike what happened in 2020, 2021 with COVID. Um, I think that a lot of Australians have become somewhat reckless in terms of their finances, reckless in terms of their attitudes towards debt. They've taken on significant risks that they shouldn't have taken on. And whereas for me, with no mortgage, I'm sort of relatively stable in terms of my household finances. I think a lot of Australians have as a lot of Australians could have been in a similar situation to me, but they chose a different path. And Martin, if we can just go to the next slide before I sort of hand it over to you, there's an article that was published in news.com only last month, and this is the organization The Finder, basically saying that 1 in 5 homeowners are now saying that they've taken on too much debt, and basically the debt burden has become bigger than what they expected. So maybe it goes back to the point you made earlier, that people had a certain expectation around what interest rates were going to do, what income growth was going to do, and those expectations haven't materialized. And now 20% of households saying, well, it's worse than what I thought it was going to be, and now I'm struggling. So I think in this instance, unlike in the 2021-22 period, I think that there's more blame on individual households and poor decisions as opposed to government policy.
Well, I think it's both and, right? So if you think of New Zealand, they put their interest rates up a lot higher. As a result of that, house prices have fallen 15 to 80%. Rentals are down. Inflation is now well under control and the interest rates are very low. In Australia, they didn't put the rates up high enough. But I do absolutely agree with you that there is an accountability for individual families about how they're thinking about their finances, the expectations that they set themselves, and also the planning that they do or don't do with regards to how they manage their finances. Like I said, half of households don't really do a cash flow, so they haven't really got a strong sense of money in, money out. There's a very much a she'll be right attitude. After all, it worked okay in the early 2000s, didn't it? So what's different this time? Plus, I would say this, the banks have been extending and pretending. So when people get into difficulty and under their hardship scheme get asked to help, they tend to sort of refinance and extend the loan, but it just means that you actually end up paying a higher interest rate, potentially for longer, or more interest for longer at least. And so all of these things come together. So it's not a single point of blame, nor a single point of solution. But for an individual household, I always say it comes back to the decisions that you take in terms of how you deal with the money in, how you deal with the money out, where you're spending, what are your priorities, and the debt bomb that many people are sitting on won't get diffused until such time as people perhaps take a little bit more responsibility for their own decisions. That's uncomfortable, but I actually feel very strongly that that is a very big part of the story. I also would say politicians, plenty of blame there. Central bank, plenty of blame there. But actually, at the end of the day, doesn't it come back to what individual households do? After all, they are meant to be free people, aren't they?
Yes, yes. Well, I mean, like, we will see about the hate speech laws and whether we remain free as a people. But I mean, the thing is, like, people do have choices in terms of where they put their money, where they spend their money, how to manage the current circumstances. And you know, um, given that I've been an economist since I was 16 years old, I mean, for me, it's always, hope for the best, plan for the worst. And obviously, knowing where we were headed, I had these concerns about debt many, many decades ago, and so I've always sort of taken a very prudent action and placed myself in the best circumstances possible. And whereas everyone around me is drowning in debt and under pressure, I think you and I are in a very different situation. And Martin, even in the context of the 2025 election, I went to a couple of political events, and I just said to people admittedly I'm out of touch. I don't feel the pain of ordinary Australians because I made different choices and I'm in a different circumstance. So again, for those that are watching, maybe some people don't want to hear the message that I have, but uh, if you have taken on a lot more debt, I would encourage people to take as much aggressive action as possible to reduce the debt that you have, reduce the risk. And obviously there are strategies of how to do that, and there are professional services that can help individuals with that. But Martin, no doubt that some people reach out to you for consultations, and if people want to reach out to me and obviously get my thoughts of how best to manage the current economic conditions, happy to assist in that regard. But yeah, the thing is that I in summary, Martin, in 2018, I wrote that economic Armageddon was coming. A lot of people thought I was a conspiracy theorist, a sensationalist, someone who just wanted a headline. And I didn't know whether it was going to be an inflation crisis or a deflation crisis. And obviously, with COVID, I said it was going to be an inflation crisis, and here we are at the highest levels of debt, the highest cost of living crisis in Australian history. Societal problems right across the board, health, mental health. People don't have confidence in the future. People are not able to have children. The future demographic future of the country is in peril. Um, and here's the thing, Martin. Going back to 2018, what did you and I continue to say? We have to shrink the debt, and shrinking the debt means a deep recession, if not a depression. And you have to shrink the debt quickly, and you have to not worry about short term personal pain, because yes, while certain individuals will suffer, some people will die from suicide. The collective health of the economy and of society comes above individual considerations. Having said that, since 2014, Martin, I have had repeated conversations with federal parliamentarians particularly in the coalition. Um, Many politicians, I've said to them, this cost of living crisis will not go away until you take specific, deliberate action to shrink the debt. And Martin, and in the last 6 months, when I was in federal parliament, I met a coalition backbench MP um, who said to me that my solution of shrinking the debt and purposely putting the economy into a deep recession, if not a depression, was impractical. And he put it to me: is it possible that we could grow our way out of the debt? And I said to him, show me a historical case study where that's been successful. And the answer is it's never been successful. There is no historical case study where you can grow yourself out of a debt bubble of this magnitude. And so this crisis is only going to get worse. And more people are going to suffer uh, uh, until government takes deliberate action to crush the economy. Because, Martin, crashing the economy, one of the impacts of that will have is actually it will change people's attitudes towards debt. So while a second ago I said that this second surge of debt, the first surge of debt during COVID-19, I blame the politicians in the RBA and APRA. The second surge of debt from 2023, I actually blame households more than policymakers. But those attitudes towards debt and these poor decisions, if you actually have much higher interest rates, if you have less government assistance, if you actually have politicians basically say to households, you have to make ends meet and you can't look to the public purse to bail your way out of this, people's attitudes will change. People will take less risk. People will start to save more and actually make better decisions. And when people's attitudes, or what John Maynard Keynes would call animal spirits, once they're tampered down, that's when you can have real different economic behavior. And so that's why you have to, you've got to change the incentives around debt. You've got to change the incentives around saving, and that's the only way for us to move forward. And unfortunately, there's not a single politician in federal parliament who's prepared to do it. There's a number of politicians who say they actually understand the argument, they can see the history, that they can accept that what I'm saying has merit, but they keep on saying to me, in a democracy, it won't work. And so we're in a crisis. We're in a situation, Martin, is we're either going to head towards hyperinflation, or we have to seriously look at whether democracy is viable going forward. And that's the circumstances that we're in. And so for those that are watching this program, uh, you know, if you are in a troubling spot, if you don't make dramatic personal choices, it's only going to get worse. But also, I would say if you continue to vote the way you have been voting for these establishment politicians, you're not going to get change. And so, Martin, as of tonight, One Nation, as a political party, is the second highest political party in terms of news poll in Australian history, like in terms of Australia. So this is the first time in Australian history where One Nation is now outpolling the coalition. And so we are seeing seismic changes in how people are voting and how people are intending to vote. And I think that's a healthy thing, because the coalition and Labor has driven this economy into a ditch, and we need a radically different alternative if we're going to get our way out of it. So whether One Nation's the solution or another political party, we'll see how that plays out politically. But yeah, we need a depression. We need to shrink the debt, and the current crop of politicians keep on saying to me, "I won't do it." So it's either hyperinflation, or we kick out the politicians, or if the Australian people are not prepared to accept the medicine, we have to look at whether our current democratic system is the right political model moving forward.
Well, very, very provoking there at the end, John. And I think you're right to ask some very important questions about our political system and processes. What I will just say before we end is that if people are actually in financial pressure, the debt helpline, the National Debt Helpline, 1-800-007-007 is a really good place to go. That is actually government backed, of course. And you want to be very careful if you go onto Google and start searching. You'll end up in places where they will charge you to provide help, but actually the government debt helpline is the place to go to. But as we bring to the end of the show, John, I think it's worth underscoring again that we are in a bit of a deep hole here. There are things that could be done, but those things perhaps are uncomfortable for individuals or indeed policymakers. But I think we've explored it really well today. And John, thank you very much for your time as always. And I'll look forward to picking this conversation up, because I think there's quite a lot more we can explore in terms of how precisely politics needs to change to be able to actually take us off in a different direction.
Absolutely.
Martin North, John Adams, in the interest of the people. We'll see you next time.